Good morning, everybody. It's Friday. It's nearly home time. Can't wait. Nearly pub time. Morning, Kay.
TGIF, well done, Hammers, Ryan. That was a
Yeah,
good
just about.
fight back, a really good fight back.
Yeah, we could have made it much easier ourselves. They weren't all that, but we made it hard work as usual.
Football needs to be a bit stressful, you know.
Says the Man City supporter. You wouldn't know what stress is, mate.
Yeah, I mean, we are very stressed all the time, wondering how many goals Haaland will score. So that's
Yeah,
a
exactly.
big word. Anyway,
come and support a team like mine. You'll know what stress is like, mate. That's why I've got no hair. Anyway, yeah, a good night up at the Happy Hammers. We'll see what happens next week when we go over to Amsterdam. And considering, I think I heard last night there's about 5,000 West Ham travelling to Amsterdam next week. We've only got about 2,000 tickets, which have all sold out. Sorry?
Are you part of it? Are you travelling?
Yeah, I'm going over there.
All righty.
Yeah, nice one. And I think football's pretty low down on the agenda, seeing as most of those 5,000 will be staying in Amsterdam. So yeah, should be a quiet trip. I might make it back for the following week after. Anyway, enough of my jaunts around the Europe. Let's get into what's really going on in Europe in markets and stuff. ECB will start off with those clowns. ECB's Cost says we are now closer to the final cycle of hiking interest rates. Lagarde out with her usual waffle that the fight against inflation isn't over. And ECB's Nagel, I think he's been out every day this week. Another pump towards a September hike by saying the ECB tightening might be required after the summer break. So keeping hikes in the pipe. On the data front, a few bits and bobs out. Let's start off in the good old UK, where GDP month on month came in at negative 0.3% for March, although the quarterly number, which you can take as Q1 stuff, came in as 0.1%. So a bit of a gain there, but still rather low and flat, matching the same quarter last month. So not really much to talk about there, as we've been saying, growth not expected to be booming or busting any which way. Industrial production, a little bit mixed, higher on the month, not as bad on the year. Manufacturing showing a nice bounce in March as well, up 0.7%, and not suffering as much year on year. So as you can see there, the three-month GDP, which is basically the quarterly number, preliminary now at 0.1% there. Trade balance data, not as bad as not as bad as expected, and a slight improvement on last month, but again, nothing to write home about on that front. We'll get into the BOE after we've got through the rest of the headlines and data and whatnot. Coming through to Europe, and CPI being confirmed in France at 5.9% and 6.9% for the HICP number. Spain as well, no changes there to the flash numbers, but confirming the jump over last month there. Actually, same with France, a jump there. So sticky inflation remains in Europe, and that's the theme that a lot of the ECB bods have been banging on about. Let's have a look. Was there any data else? Nothing this morning, overnight.
Yeah, the Kiwi data.
Kiwi data. What was the Kiwi data? I must have missed that.
Well, you've got this business PMI last night, and then the much lower inflation expectations sending Kiwi down quite a bit overnight.
Yeah, those expectations there for the quarter, 2.8% versus 3.3% prior. So some bit of a washout there, as Kay said, and a little knock lower in the Kiwi on that data as well. Back to the US data yesterday and the PPI numbers, not much to write home about. Probably coming in a little bit softer year on year, 2.3%. So a bit like CPI, just minor differences in those numbers there. More probably a topic to talk about is the jobless claims, which saw a quite steep jump to 264,000, 4-week average up as well. Continued claims, though, was up, but not as much as expected. So just something to keep an eye on there. We're still not really hitting any sort of high levels. If we start seeing numbers above 300s, then maybe we need to look at what's going on. But as you can see, we're just sort of waffling around this 200 mark, but it has been ticking up the last few weeks, so we need to keep an eye on that. Did you? I caught a headline, but I didn't catch the details. Kay, was there something in the jobless claims that gave it a kick?
No, I haven't seen it, but you know, there's still like left, right, and center people getting laid off, and then perhaps they are now joining that claims number. But we have to note on the whole, if you can put the chart up again of the claims.
Yeah, give me 2 seconds. There we go.
Yeah. And then scroll up a little bit because we don't see the actual chart. Oh yeah, just it is. If we look at the past weeks, we have to note the uptick, right? That we're in, and I think rather than pinning it down to one number, we have to acknowledge that from March, April onwards, after March, April onwards, we're seeing slightly higher numbers. So it is something to just note. But it's not yet the big ones. We've had similar in 2022, as we can see there. So we are not yet at alarming levels, I would say. But it's something we have to keep an eye on, just because it is ticking up a bit.
Yeah, I mean, you can see when we had that period of really strong growth before the COVID mess, which you can just about see underneath the logo there. So we're still in that sort of bracket. So there really is no real worries about this. As I say, if we start to see it trending up, you know, over 300s and continuing higher, then that's going to be something we need to look at. But down here, we're still running at low levels, and you know, there's still no red flags over the jobs market, in my opinion.
No, because it could be just a temporary, because of all those layoffs that we have seen. Could just be a temporary effect. It's just something we keep an eye on. Because of that last big domino, the labor market still holding up more than just holding up, still doing very well. But then we see secondary numbers showing perhaps a slightly different picture. So that's why we keep an eye on that one.
Yeah, things like the jolts, obviously, and the other bit, the PMIs, bits and pieces. So there's certainly been some small indications that you know, there's some waves, I would say, appearing, but they're not no tsunamis yet. So until that time, we shall just carry on as is. Over to the Fed, and Kashkari says that, speaking of jobs, funny enough, that is not convinced the US is at maximum employment. I wonder if he's marked the top there. He's not seeing an evidence of a crash in consumer spending or a slowing in the services side of the economy. Fed's Bowman said Fed policy rate will need to remain sufficiently restrictive for some time. Additional rate hikes likely appropriate if inflation stays high. The labour market stays tight. Fed rate hikes are having a desired effect. And Fed policy is now restrictive. So I don't know what he's saying there. He just said will need to remain sufficiently restrictive. He's saying it is restrictive, but he's uncertain if it is sufficiently restrictive to bring down inflation. Too many restrictives there for a Friday morning. Over to the geopolitics, and a US senior admin official said they expect more engagements with Chinese officials in the coming months. Both sides recognised the importance of leader-level communications. You remember yesterday it was touted Biden might have a call with Xi, and some lower-level aides, Chinese and US, had a little chinwag some more perhaps to come from that. China and Australia trade ministers met in Beijing, and the Australian trade minister said we still have some way to go to establish usual trade across the board with regards to China. On the
polite
war footing, yeah.
That's a polite way of saying we're nowhere near.
Yeah.
There's a lot going on about Chinese practices and stuff. Yellen is talking about it. The Europeans are talking about it. Something to keep an eye on, I think.
Yeah, we had that Italy story about them pulling out the Belt and Road, and you know, there's all potential further sanctions and all the chip stuff. It's all a big melting pot of bubbling pot of stuff that's going on. But yeah, over to Russia, and the US has supplied some missiles to the Ukraine, and that's not gone down well in Russia. The Kremlin said this will require an adequate response from our military. This is part of something the West has been reluctant to give Ukraine long-range missiles, and the UK have now done so under, I should think, strict instructions that they are not to enter Russia in any which way, shape or form, as that would escalate things. And that's been behind the reluctance of the West to supply longer range missiles. So one would assume they have that promise from the Ukraine, but those are going into effect right now. We'll have to see what Putin does with that. On the debt ceiling guff, we were supposed to have another meeting today, but that's been booted. Pretty much all sides saying that there's not enough progress been made to warrant another leader meeting. So that's been booted to next week. Not really unexpected. All this can kick in, and said there's going to be tons of meetings and you know, conciliatory talks and constructive talks, but a load of waffle until we actually get a deal. So expect more of that. Right then, let's have a look at His Majesty Bailey over at the Bank of England. So they hiked by 25 pips as expected. The vote was as expected, 7-2, which takes the rate to 4.5%. In the statement, the BOE sees risks to the inflation forecast skewed significantly to the upside. If evidence of more persistent pressures, more tightening would be needed. Some of the press have made a big fanfare of the biggest hikes to GDP forecasts in the history of the bank. So what did they do? Well, they hiked 2023 GDP from minus 0.5% to plus 0.25%. Ooh, we might have 0.25% growth in 2023. They also put a big hike in 100 pips for 2024 from minus 0.25 to plus 0.75. And they hiked 2025 by 50 pips to 0.75% gain for 2025. So big uplift in expectations, which point to one thing, that their forecasts aren't worth the paper they're written on in the first place. Central bank making that big an adjustment to their growth numbers is just ridiculous. It's folly, and it shows that they really don't know what they're doing. BOE's Bailey came out and said the outlook for growth and unemployment has improved. Inflation remains too high, and but sees modest and positive growth. He says we have to stay the course, and there's good reasons to think CPI will fall sharply from April. Past rate hikes will weigh more on the economy in the coming quarters, and we are not giving a directional steer on rates. So that was all well and good. He threw in some little dovish points there, but then he came and did the press rounds and said that I hope we are close to the end of the rate raising cycle. We have not yet seen the evidence that allows us to be sure rates can stay on hold. So that's a little hawkish tilt there, but said we are approaching the point when we should be able to let the level of rates rest. And again, I hope we are close to the end of the rate hiking cycle. So he did it again, didn't he, Kay?
Yeah. I mean, that's
a bit hawkish in the opening part of the Well, the BOE statement was hawkish, and then he was a little bit hawkish in the opening comments, and then reverted to type. And here we go, another central bank meeting where the currencies dived after.
Yeah, I mean, he's done it. He's scoring more hat tricks than a top footballer. So I mean, he just can't stay away from being dovish at some point. And yeah, the funny thing was that the statement was relatively hawkish, and then he succeeded once more to kill the beast. And the pound ended the day quite a bit weaker than where we were pre-meeting. And yeah, here we are. What we want to make of it is really, I mean, for the currency, I mean, really anyone's guess. Yeah, we've seen those numbers being anemic, perhaps is the right word this morning. But still, I'm seeing some green on whatever is industrial production, business investment, construction output and stuff. I don't think the UK numbers are that bad, you know. And I fail to see the reason why he would be hammering on the sterling all the time like this, because he knows exactly what he's doing. Oh, well, he should, or unless he's really, like, I think, the worst central banker I've ever seen, and he doesn't realize what he's saying. But he's just very counterproductive all the time. And this was a case of, or an opportunity of having sterling shine a little bit, and he just hammered it again. And especially, I think that was after you. Yeah, that was after you left already. Came out on that Bloomberg TV interview, and it was as if, all right. I mean, this is maybe the end of the hikes, where it was 180 from the statement.
Yeah, exactly.
The guy
I mean, a few of us jumped into pound longs, having a quick jump in on the announcement and the statement. I was in at 126.07, I think it was, and I had a stop at 125.60 as I was leaving the office. So I'm glad that I had a stop in on that one, because when I saw it later on, I was like, "What the?"
Yeah, I did the same. I was well, okay. I did the same. I just re-entered the part of the short euro sterling that I had on the days before, but the thing just reversed. And yeah, I mean, the good thing somewhere to take away from that is that, again, we got the confirmation that whenever Bailey opens his mouth, sterling is going down. So there's actually no. We don't need to be an economist. We don't even have to be a strategist or a chartist or whatever. Whenever Bailey opens his mouth, just sell the pound.
Yeah, we need a Bailey indicator.
Yeah,
we can put on our charts. Just a robot. If Bailey speaking, initiate sells.
Yeah, exactly.
But, anyway,
and then look smart.
Yeah, exactly. But as much as there's damage done to the quid, it's not breaking the trend at all. The trend's still in play. Big figures held up at 125, as you can see from the chart there. It's been a level of interest previously. Then we got that 124.50. Maybe we're going to see a similar reaction to euro dollar, where now we're just in a bit of a rally sell mode as opposed to dip buy mode. But I think unless we get under that 124.50, this whole trend still remains in play, and we're still miles away from even the 38.2 fib of this. So a long way to go before this trend looks like it's turning around. Maybe it's a bit more hard work to get back to the highs, do you think, Kay?
Yeah, but especially that we've seen after the latest data. That the dollar is coming back all the time, right? So yeah, I think this going back to those highs. If we get back up there, then I think it's going to break. But are we going to get back up there is the main question. I don't know what's going to, but there's a lot of uncertainty around the dollar, right? We're talking about the debt ceiling. We're talking about mixed data coming out. By the way, this afternoon we have the preliminary Michigan, or is that the second reading already?
It's a flash. It's a flash, yeah.
It's the flash, right? So we can have a bit of volatility this afternoon around the dollar. but we have to acknowledge that the dollar is making comebacks, and same on the yields. Well, I mean, I had a bit my doubts about why yields were going lower. I think there's something to do with the debt ceiling and stuff as well, of course. But we have to admit it's coming back. We've traded it pretty well in some currencies in the room, as people who are in the room know. We hit that Aussie dollar when it was around 68, which was a nice trade. And yeah, the dollar is just coming back, so that's going to make it tougher for the cable to sustain rallies in current scenario. Same for the euro, right? We were, as you were saying in the room, I think a bit earlier today, we were banging against 111, looking for the break for 112. Well, no, we failed, and now we are back to the bottom end of the range, and wondering if 109 is going to crack for 108. And that I think is probably going to last for a little bit, because of all those uncertainty that we have in around that ceiling and things. But if it becomes clear that they are going to have a deal, then perhaps the dollar will shoot a little bit, because I think that should put yields higher. So yeah. So if you are that's a long answer to ask a long answer to the question: will cable break the highs again? That it'll depend more on the dollar, I think, than sterling.
Yeah, so I mean, I'm in two minds. You know, taking the quid cable, is this a dollar move, or is this just yet another central bank that's potentially coming to the end of its hike cycle?
Yeah,
I mean, you know, what do we really think the BOE's got in them? Two more hikes. You know, the ECB may have 2 more in them. The Fed may have 1 or 2 more in them. You know, maybe it's now the market saying, you know, okay, these guys have had their little hike run. Everyone's coming to an end, and now we're going to see pauses everywhere. So
yeah, and we had that after the RBNZ. We had it after the RBA.
Yeah.
We had examples enough now of the market having the same reaction after each central bank. Only the Fed was a bit more mixed, but then yet the dollar was sold a little bit. But then we had the same thing on the ECB as well. It's exactly the same thing. So the market seems to position before, and then takes the positions out, which again gives me at least the impression that it's going to be hard to break a lot of ranges before we see clarity in some stuff, you know, the debt ceiling, the labor markets, the stuff. And we are going to see, once the debt ceiling is resolved, we are going to see then again a pickup in importance if we are at the end of the hiking cycle, which we may now start to think about. Then the real data are going to gain in importance again, and then we are going to start to move finally on real data again.
Yeah, exactly. And what we're going to be trading, we're not going to be trading hikes as much as trading these dreaded cuts, and who's going to be first, who's going to cut the hardest. And you know, we're going to play the opposite game to what we've been playing for the last 18 months or so, and that's going to be the drivers of these pairs. That's going to tell us, you know, if the Fed are going to be more sticky than the Bank of England in keeping rates higher, then, you know, again, cable's going to suffer, and maybe we start to reverse this trend downwards.
That and a little just a little tip to people who haven't been in the markets for as long as we old rats have been, with higher yields than compared to the 10, 15, 20 years ago, or the past 15 years, that we have seen constant low yields. We have been how shall I say, complaining a lot about volatility, but with higher yields, de facto volatility will stay at a higher level than when yields are hovering around the bottom. Higher yields usually call for a bit more volatility. So that's actually, we can be hopeful that the volatility is here to stay, because that's what we need, right?
Yeah, exactly. And I think that's also going to bring a different mindset from investors. You know, if economies are going to start flatlining, potential recessions, albeit not that deep, you know, you're not going to get perhaps the yield in stock markets. So where else can you get a decent yield for 3, 4, 5% yield on your money? It's going to be in bonds again. So don't rule out seeing a lot of moves, a lot of flows between the different asset classes as people chase that yield, because if rates are going down, so a yield's going to go down. So you might as well lock in at 4%, 5% in a government bond for 10 years, because that yield might be 3% when the Fed starts cutting. So it's all about investors, you know, where they want to park up their money and get the better yield for the low risk, for those who are low risk takers. And then the high risk takers, you know, they're probably going to start getting, as they have been, into corporate bonds and maybe some junk stuff. And again, trying to just lock in that yield. So flows are going to be important in that part of the tail. And we're probably going to start playing that in earnest. I should think, probably from July, when we finally know where the tops are in for central bank rates. Do you reckon, Kay?
Yeah, and usually end of August, September can be a volatile period. We have seen that historically when people come back from holidays, and but also it seems like the hot summer is heating up some geopolitical brains as well, and there's always a kind of period of volatility starting end of August into September. That's traditionally a period where there's volatility, and as we can see now, people are starting to call the end of the rate hike cycle for all the major central banks, where Japan still has to start. We have to take look at Japan through different eyes, but all the rest starting to look at the end of the hike cycle. And if we would think that June is the last hike, perhaps for the major central banks, then there is this digestion period, and then come August, September, we may start to look at different stuff, right? So July, August, September could be pretty hot.
Yeah. So I hope we're giving you guys and girls a good bit of insight on why we look at the fundamentals and why we like to look ahead as to when the big changes comes, because when you do get these changes at central banks, this is where the big trends happen. This is when cable goes from 126 to 120, or dollar yen goes from 138 down to 130s or 125s. So if you know what's coming, you can't be surprised, or shouldn't be surprised, if it happens. That's why we look at all this stuff, and we like to take a little bit of a longer term view of things, just to see what's around the corner, because it's all about expectations, not what the market wants to do now, not what the central banks want to do now. It's what the market thinks the central banks will do later, because that's where it likes to get in early. Right, just looking around some of the pairs. I'll hand it over to Kay in a moment. Aussie dollar, as Kay mentioned, as we spoke about yesterday, this failure of 68 continues. We're now nudging below 66s. We got this 66.80 down to 60 zone to mess around with now. So going to look to see whether we hold up there or whether we pass through. I've been slicing my short off as we dip. If we do get through this zone, then we're probably bound for 66, or the low 66 is not long after. But there's plenty of levels to come in. Again, I don't think we're potentially at the end of a trend or breaking a trend, because this is the bigger trend. We have been through the 50. We can't get through the 61.8. We've had a good period of consolidation, so maybe we still just mark a range by getting down maybe to this these 65s areas down here, these couple of bottoms down that area. Plenty of traffic going to be in the way though, but as we said, the momentum is with the sellers. So until that changes, we look to run our trades as far as we can get them. Dollar China, I need to keep an eye on this one, because I have been trying to knock some off up at 96.50, and we're just trying again. So we had a secondary move yesterday that held. We're now up here again. So that suggests that we may be on for a bit of a break in this one. If we do, then we're looking at, let's stick on that one. If we do get above here, then we're looking at potentially getting up towards the high, towards 698s, 99s. That's going to be the next area, and obviously coming well ahead of that big 7 level that's always has us saying things. But the fact that we're having a third go pretty much straight after the one yesterday says to me that maybe we're going to get a little bit of a break going on this one. Did you jump back into some of this, mate?
Yes, sir.
Good man.
Yes,
good man.
I have. Yeah, it's smaller than what I had prior, and perhaps I should have done more because that 691-ish bit of a trend line was holding very well. But yeah, I still got a little bit. And since it's a little bit, I'm going to just let it run to 7 or I don't know, reload perhaps a bit lower. There's a bit of geopolitics playing in there as well, I think, keeping this dollar-China bit. As we were talking about comments about Chinese strategies and stuff, that's still playing a role as well, and it's keeping the investors from buying Chinese yuan right now, I reckon. So yeah, I think it's still a trade, still a valid trade, right? For as long as we hold at 691. If it goes back down below 691, I'm gone, and we'll call it a day. It's going to be a free trade now. Whatever happens. So yeah, I mean, just let it run and see what happens.
What are you thinking about up at the 7? I'm don't know whether I want to try a short if we get up there.
I'm taking my profit at 7. So
yeah,
and then we'll see what happens. Yeah.
Yeah, I'm gonna have a look at that one. I don't know whether to take some off and just keep a bit on, or maybe just try a separate initial short and see where we go from there.
Yeah, I wouldn't. This is one where I'm not inclined to really buy a break above 7 right now, because I've got that rangy feeling on most of the markets. So it's a bit geopolitically driven as well. So at one stage, it's good to just take the profit, reassess, break 7. We need to get above that 70, that other blue line there, right? 702, 703 is really where we need to get above to keep on going.
Yeah, exactly. Quite a big zone up there. And then we keep our eyes open or ears open for any official chatter about the level of the currency, because that's usually the key as to whether to keep in, stay in, or get out down. Euro sterling, that flipped me out of my long try that I was getting into around the 87s as expected. Well, it tipped me out by bloody 5 pips and then rallied all the way back up again. But it's looking a bit messier at the moment with what's going on. I think once again we're seeing that volatility differential between cable and euro dollar that has a say in this, why it's jumping around so much. So on the text front, it has held in the traffic area down here for now. The bounce doesn't look overly strong. We got it up to 33, so we got back through some of these levels that we had in here. It's kind of a bit shorter, but again, we're not. It's smelling a bit dead cattish. So we're back below. We're knocking around the 87 handle. So again, look for this 86.90 to perhaps show up again. If it holds, might suggest that we're going to keep an upside bias to it. But if we can't hold above the 87, that's going to smell a bit weaker, and maybe we're heading lower. So 87 is still my sort of key point, 86.90, and I think where we close the week might be important for that one. Kay, did you want to have a little look then?
Yeah, sure, because there are one or two currencies I would really like to talk about today. Let's start with just a couple of the traditionals where there is perhaps something to say for the short termers, but for the longer termers, absolutely nothing to see here. We are in this range, right, on the euro dollar. And yes, we have broken back below this 109.40 zone, which also capped this morning. So that for the intraday is relatively interesting, I would say. But then we are trying to hold the 109 on the other side. That if anything happens, and I'm looking at those yields are creeping slowly higher again. So that may weigh a little bit on the euro this afternoon. We've also spoken about the dollar. Getting a bit of its mojo back against other currencies. But again, to me, this is going to be a big one here. This is going to the 108, 107.90, 108. It's been traditionally a crossroad for what's happening in the euro dollar. And I think it will be no otherwise if ever we get back down there. And looking at the global situation right now, I wouldn't see why we would break back below unless we get a quick resolution of the debt ceiling with some spending cuts in the US that could push those yields higher and the dollar lower, the dollar higher as a result of it, and pushing this euro dollar down. But we're going to have to look very, very carefully what happens if we get down to 108. For the rest, range. Cable, you're already covered it. Euro sterling, just one thing, we've broken through this one here, this little trend line in the middle of this slowly down sloping channel, and we haven't really retested it yet, but that's one that I'm keeping an eye on. As I said earlier on the show, I also tried to sell the break here actually yesterday on the euro sterling on the BOE, but that didn't work. So I went out of that with let's say a few pennies lost, but not so much of a headache. I voluntarily kept it small because you can never trust a Bailey. So that's one thing. Somebody asked a question here. Oh yeah, the metals. We have to look at the metals, right? So I think why they're both coming down so quickly is about uncertainty. Uncertainty around the debt ceiling. A lot of Yellen on purpose driving everybody crazy and nervous about what could happen to the US economy and what could happen to if they don't reach a ceiling. And I think a lot of it has to do in the metals with rather risk than yields also. Of course, if the yields start to creep up again, the metals could trade weaker. But I think it's got a lot more to do with uncertainty and certain levels not holding. Gold is one example. So you see we are on a little bit of support here and then a bit more support down here. If it would start to break below 1970, and I'm not sure since we're Friday if that's not on the cards, just wash everybody out. Be a bit careful because it could see an acceleration. Silver, yeah, silver is also we've seen this big move lower in copper and stuff, and oils are also failing. Silver is that industrial metal, right? And whenever metals come down, first of all, silver is a smaller market, so this is always going to be partially an accelerated gold. So if gold comes off, usually silver goes down faster. But it's all about the uncertainty as well. So we've broken through this 24.40 yesterday and accelerating now. I think we are not too far away from major support. Call it 23.5 down to 23.30s. We've got a 20 cent support zone here, and well, you know, people in the room know that I've been selling in this leg up, so I've let a fair bit of my add-ons go. I've got like a base position that I've taken like anywhere, around here years ago, but I'm still trading it around. I started this morning just around this line here to re-add what I sold above, but I want to be patient because there can be a lot more shenanigans coming and sending this stuff down. If we would start to break below this this trend line, why not? You know, get back down to 21 or so. But I will be in very small pieces, reload in this very wide range, because I think at the end stuff will be resolved, and we are going to start to creep up again. And being close to the end of the hike cycle, a lot can still happen before, but and in the end we should see some kind of resolution and yield starting to perhaps creep lower, and then the metals could start to over the more medium term start to get higher again. Derek, sterling kiwi, you're always coming up with pairs that I have no clue about, mate. But anyway, let's look at what's happening in those antipodians. As Ryan already mentioned, big rejection up here, and now it's possible, you know, that we are going to go all the way back down to this one. I was sure I closed everything yesterday just below 67 the figure. I'm actually just trying to shyly accompany it, but it's just like small punts. It's not a real position really, but I still think for as long as we can't start to recover 67 and a quarter or so, that still the way is lower, and it's going to be helped by this one. This one really got a severe knock on the head. So you had this first effect that we had post central bank meetings and stuff, and then overnight this big move lower when this PMI went back down below 50, and especially with the inflation expectations going back inside RBNZ's target range, which is usually a case of that is it. That's no more rate hikes, because that is what they want to fight. So if they want to fight that, then it usually means that's done. They are done with hikes. So I expect on the Kiwi to really find sellers on every decent move up. And as usual, okay, we've got like 62.15 here is a bit of a level, but you know this zone right around 62. It's always been a battlefield. Up or below 61.90 figure is going to be important again, I reckon. If it breaks, and this may accelerate here, and why not go all the way back down to those prior lows here. So keep an eye on the Kiwi. That one I really think is going to remain weaker now for a while. And so anywhere up to 62.60, yeah, 62.60. Why not? Already have a look at it perhaps. And that partially replies your sterling Kiwi question, right? Because you heard us talk about the sterling, a bit mixed, but still I think sterling shouldn't be too weak. So if you look at stuff like sterling Kiwi, and I don't even think I've got it charted, to be honest, because it's something I don't trade. Look at it. You see, my chart is blank, but you can just see the jump that we had here, and look, just one line here, 200 is your line, right? 200, if that holds, it's a good sign, I would say. So yeah, there it is. There is your 200. That's the one that you will be looking at. What did I have here? Oh yeah, big screen. Okay, I want to look at a couple of other currencies now. Oh, before I move on, have a look at this one. This was one that I put yesterday in the flow room. In the chat room, and this Aussie Kiwi nearly down to the pip, held the 106 level. This is your major support zone on the Aussie Kiwi. Of course, it's been held by the data, but that's what the market does, right? And now we are. Let me see where we are. Yeah, we are already through this through the first resistance here. I think if you get any move back down to 106.70, we may find a few buyers there. But now I want to talk about one currency today. As people know in the room, and I think I've already spoken about this one as well, perhaps on here, but if not, for sure on Face. We have been buying this because I had already very little confidence in what's happening in the rand in South Africa with Eskom and the rolling blackouts and stuff like that. So we've been buying it, quite a few of us, by the way, just ahead of this level. Then we saw the break, added a bit, and then we broken violently through the prior all-time high, because the US is now alleging that South Africa shipped weapons and ammunition to the Russian to fight in Ukraine. That really sent it on a spike here. Briefly touched 1950, and then this morning we had a denial of the sending, no, but saying, one of the ministers saying that they did not approve the sending of those arms or ammunition, and that caused, if we look at the shorter term, that caused a pretty steep move back down. This is a 1.5%, right? It doesn't look like much on this time frame, but it's 1.5%. So now we are trading around 1926, and I think this zone here, 1915, 1910, 15 is going to be your first zone of importance. But I want to get back to the daily. If you look at what we have been doing on the long term, even if you look at what we've been doing here, we spiked through it once and then a big failure, and now we are trying to get there again, and that's around 1975, 1980. And if you look on the daily, if you take this move here, and then you add it to where it broke above, it's also pointing at 1975. And if you take this channel, that's going to be a bit higher. That's around 20. If ever dollar rand would reach up there, that's going to be a very important zone. I think that perhaps it's, well, I will at least take profit on longs that I have up there. I am trading it relatively actively, but I will take profits up there. But I was saying this morning in the room as well, if that would go, I don't really know where this is going to end up, because then you are going to have to look at stuff higher, and then it's going to have to start to have Turkish liras, right? Especially by the speed of those moves. So keep a close eye on what's happening in the rand. For as long as this stays above 1880, 1870, 1880, even here, but I think here already it should start to hold now around 1880, 1870 if we get a retest. So this is one that I'm in for now, and it's a very interesting one, and it's also a very fast one. So manage your positions in there. Right. Yeah, makes not a lot to say, but we did hold this trend line. I'd love to see it at least back to around here to perhaps start to dig into some shorts again. But the fact that it holds here needs to be respected. So and it's also not too far from this prior low. So on the MEX, for the time being, I'm not in it, but keep an eye on those prior lows and this trend line. And then the other one here, seeing that the euro is like really losing steam. This is the long-term channel is still very much intact. And also, there's many articles out about how good it is to be in Mexico right now. So there must be a lot of inflows into Mexican peso right now. So I'm really hoping for bounces here to try and get in there. There will be a time where this will be a less obvious trade, because we are probably very likely actually close to the end of the hiking cycle in Mexico, but it's still an 11% currency, and it's very hard to be short of that one for more than a few sessions. Euronoki, I showed you this one. We tried 3 times to break below, and it didn't hold below, and with oils coming back down, it rejected it. It rejected it, and pretty hard. I tried the break, but I really very quickly moved out again because it didn't work at all. So now we are back very firmly into this channel. Dollar Norway did the same, although it did not break the trend line. Okay, so this is now a very important zone here in the low 1040s. This is one to really keep a very close eye on if ever we get a retest of that trend line, because it has been respected a good number of times now. So this is one to keep an eye on if you want to play some Scandies. And this one is really also driven by oil, by gas, what the Norwegian central bank is doing as well. They're still selling Norwegian kroner every day. So keep an eye on this level. And we are on relatively interesting levels here between 1070 and 1075. So keep an eye on that one for perhaps this afternoon to close the week. If you are, if you did the right thing and bought it off here, like I know Raphael in our room did, it's perhaps time to look at least take some off and see what happens around here, because we're also in that break territory over here. Right. Anything else? Perhaps quick look at the yen. Dollar yen held this zone 133.70, 133.90. It held again, but the yen crosses are still quite vulnerable, especially well, Aussie yen, Kiwi yen. That's obvious. But even the euro yen, yeah, we broke this one here. We broke, and we haven't even retested it yet. So keep an eye on today. It's around 147.80. If ever we creep back up there, keep an eye on what's happening, because it's also a bit of a high here. If not, watch out if we start to break back below the prior lows here. That could mean that we are on our way to lower 145s. Okay, so that for the euro yen. And I think, Ryan, I'm going to leave it there for today.
Okay, mate. Thank you very much. Yeah, what we've got coming up this afternoon, just the Michigan, which we need to keep an eye on those inflation expectations. That's going to be the big number from there. Where was it? Come on, here we go. So inflation expectations.
We don't see your screen, mate.
Oh, that will help, won't it? You know what I'm talking about then. Boom, boom, boom. So we've got the 1 year inflation expectations were last at 4.6%, which, if memory serves, was a rise over the month before. Quite a steep rise, I think it was. And the 5 year inflation at 3.0 prior, that was up as well, I think from 2.9, so a smaller jump. So those are going to be the main numbers, but also these headline numbers as well, the overall consumer sentiment, seeing whether there's any problems with the US consumer. As that's all the data really we've got this afternoon. Sometimes that can be a bit of a market mover when there's nothing else to trade. So that might give us our last bit of volatility before we all head down the pubs and wherever's.
Yeah. And also don't forget there's still this G7 going on in Japan, so that's going to give another few hundred headlines before the week is over, I trust. Although it's already evening over there, so we might be safe.
Yeah, Yeah, they're all down the karaoke bar with Kuroda. I can see it now. The guard, Kuroda, and everyone else all having a good jolly up in over in Japan.
Yeah, and Yellen. And Yellen. Imagine those three together.
Oh, yeah. Oh, I'd rather not, thank you. Just a headline crossing the wires now that the Russian Defense Ministry says Ukrainian forces have launched 26 attacks, including or involving over 1,000 servicemen and up to 40 tanks in the direction of Soledar, if I'm pronouncing that right. So this is potentially part of this spring offensive that Ukraine is supposed to be undertaking. That's obviously for risk. That could lead to significant action over there and reaction from Russia. So just keep an eye on those sort of things over the next few days. Gives potential a bit of weekend risk on that front. Right, and that's that. So thank you once again to you guys and girls for coming to the Flow Show this week. I hope we've given you some good insight and steered you in the right directions with your trading and what's going on with central banks and the data and everything else. Thank you, as always, to Kay for his valued input and all his chart analysis and everything else. And I'll thank Stel when I speak to him later. Have a great weekend, everybody. Great rest of your day. We'll see you all on Monday.
Ta-da.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.